A Random Walk Down Wall Street by Burton Malkiel is a seminal work in the world of finance, offering a comprehensive guide to investing that has stood the test of time since its first publication in 1973. The book, now in its 12th edition, is widely regarded as one of the most influential texts on personal finance and investing, praised for its clarity, accessibility, and insightful analysis of the stock market. Malkiel, a Princeton economist, challenges the conventional wisdom of Wall Street and advocates for a practical, evidence-based approach to investing that can be employed by anyone, regardless of their financial expertise. The random walk theory. At the heart of Malkiel's book is the concept of the random walk theory, which posits that stock prices move in a random, unpredictable manner. This theory implies that it is nearly impossible to consistently predict the future direction of stock prices based on past performance. Malkiel argues that the stock market is efficient, meaning that all available information is already reflected in stock prices, and as a result, it is difficult for investors to achieve returns that consistently outperform the market averages. The random walk theory challenges the idea that skilled investors can consistently pick winning stocks or time the market to buy low and sell high. Instead, Malkiel suggests that the best investment strategy for most people is to adopt a passive approach, such as investing in low-cost index funds that track the overall market. By doing so, investors can achieve returns that are in line with the broader market without incurring the high costs and risks associated with active management. The efficient market hypothesis. Closely related to the random walk theory is the efficient market hypothesis, another key concept that Malkiel explores in the book. EMH asserts that financial markets are informationally efficient, meaning that asset prices fully reflect all available information. There are three forms of EMH: weak, semi-strong, and strong, each of which suggests different levels of market efficiency based on the information available. Weak form. In the weak form, Malkiel argues that past stock prices and trading volumes do not provide any useful information for predicting future price movements. Therefore, technical analysis, which relies on historical price and volume data, is largely ineffective. Semi-strong form. The semi-strong form of EMH asserts that stock prices adjust quickly to new public information, such as earnings reports or economic data. This suggests that fundamental analysis, which involves analyzing a company's financial statements and other public information, is unlikely to provide an edge in predicting future stock prices. Strong form. The strong form of EMH takes the theory a step further, asserting that stock prices reflect all information, both public and private. According to this form, even insider information is already factored into stock prices, making it impossible for anyone, including corporate insiders, to consistently achieve above-average returns. Malkiel's endorsement of the EMH leads him to the conclusion that active management, whether through stock picking, market timing, or reliance on professional fund managers, is unlikely to outperform a passive investment strategy over the long term. Instead, he advocates for a buy-and-hold approach, where investors build a diversified portfolio of low-cost index funds and hold onto them for the long term, allowing the power of compounding to work in their favor. Investment strategies explored. While Malkiel is a strong proponent of passive investing, he also takes the time to explore various active investment strategies that have been popularized over the years. He critically examines these strategies, highlighting their limitations and the challenges investors face in trying to implement them successfully. Technical analysis. Malkiel devotes a significant portion of the book to debunking the effectiveness of technical analysis, which relies on chart patterns and other historical data to predict future stock movements. He argues that technical analysis is based on the flawed assumption that past price movements can reliably predict future behavior, and he provides evidence to show that technical analysis has a poor track record of delivering consistent returns. Fundamental analysis. While Malkiel acknowledges the value of fundamental analysis in understanding a company's financial health, he is skeptical of its ability to consistently identify undervalued stocks that will outperform the market. He argues that even the most diligent fundamental analysts are often unable to gain an edge over the market, as stock prices quickly incorporate all publicly available information. Modern portfolio theory. MPT Malkiel discusses modern portfolio theory, developed by Harry Markowitz, which emphasizes the importance of diversification in reducing risk. MPT suggests that by combining assets with different risk profiles, investors can build a portfolio that maximizes return for a given level of risk. Malkiel agrees with the principles of MPT and suggests that investors should focus on building a well-diversified portfolio to achieve their financial goals. Behavioral finance. Malkiel also touches on the emerging field of behavioral finance, which examines how psychological factors influence investor behavior. He explores how cognitive biases, such as overconfidence, herd behavior, and loss aversion, can lead investors to make irrational decisions that undermine their long-term financial success. By understanding these biases, investors can take steps to avoid common pitfalls and improve their investment outcomes. The case for index funds. One of the most significant contributions of a random walk down Wall Street is Malkiel's strong advocacy for index funds as the best investment option for most people. He argues that index funds, which passively track the performance of a broad market index like the S&P 500, offer several key advantages over actively managed funds. Lower costs. Index funds typically have lower expense ratios than actively managed funds because they do not require extensive research, stock picking, or frequent trading. These lower costs translate into higher net returns for investors over the long term. Diversification. Index funds provide broad diversification by holding a wide range of stocks across different sectors and industries. This diversification helps to reduce the risk associated with individual stocks and provides more stable returns. Consistent performance. Malkiel argues that most actively managed funds fail to consistently outperform the market, especially after accounting for fees and expenses. In contrast, index funds reliably deliver returns that are in line with the market average, making them a more predictable and reliable investment option. Simplicity. Index funds offer a straightforward and hassle-free way to invest. Investors do not need to spend time researching individual stocks or timing the market. Instead, they can simply invest in an index fund and hold it for the long term. Malkiel provides evidence to support his claims, showing that over the long term, index funds have outperformed the vast majority of actively managed funds. He also points out that even professional fund managers, with all their resources and expertise, struggle to beat the market on a consistent basis. As a result, he concludes that most individual investors are better off choosing index funds as the cornerstone of their investment strategy. Practical advice for investors. In addition to providing a thorough analysis of investment strategies and market theories, a random walk down Wall Street also offers practical advice for individual investors looking to build a successful portfolio. Malkiel emphasizes the importance of setting clear financial goals, understanding one's risk tolerance, and maintaining a long-term perspective. Asset allocation. Malkiel discusses the importance of asset allocation, dividing investments among different asset classes, such as stocks, bonds, and cash. He explains that the right asset allocation depends on an individual's financial goals, time, horizon, and risk tolerance. Younger investors with a longer time horizon might benefit from a more aggressive allocation with a higher proportion of stocks, while older investors nearing retirement might prefer a more conservative mix with a greater emphasis on bonds. Dollar cost averaging. Malkiel recommends the strategy of dollar cost averaging, where investors contribute a fixed amount of money to their investments on a regular basis, regardless of market conditions. This approach helps to reduce the impact of market volatility and ensures that investors are consistently building their portfolios over time. Rebalancing. Malkiel advises investors to periodically rebalance their portfolios to maintain their desired asset allocation. Rebalancing involves selling assets that have performed well and buying assets that have underperformed, which helps to keep the portfolio aligned with the investor's risk tolerance and financial goals. Avoiding market timing. One of Malkiel's central messages is the futility of trying to time the market. He argues that even the most experienced investors cannot consistently predict market movements, and attempts to time the market often result in lower returns. Instead, he advocates for a buy and hold strategy, where investors remain fully invested and allow their portfolios to grow over time. Staying the course. Malkiel emphasizes the importance of staying the course, even during periods of market turbulence. He warns against the temptation to sell investments during market downturns, as doing so can lock in losses and miss out on the subsequent recovery. By maintaining the long-term perspective and staying disciplined, investors can weather market volatility and achieve their financial goals. Conclusion. A random walk down Wall Street remains a timeless and essential guide for anyone looking to navigate the complexities of investing. Burton Malkiel's clear and persuasive arguments in favor of passive investing, coupled with his thorough analysis of market theories and investment strategies, make this book a must-read for both novice and experienced investors. Malkiel's central message is that the stock market is inherently unpredictable, and the best way to achieve long-term financial success is through a disciplined, low-cost, and diversified investment approach. By investing in index funds, maintaining a well-diversified portfolio, and avoiding the pitfalls of market timing and active management, investors can increase their chances of achieving their financial goals. In a world where financial markets are often portrayed as mysterious and complex, a random walk down Wall Street offers a refreshing and accessible perspective, empowering readers to take control of their financial futures with confidence and clarity.